My name is Robert Galliano. I'm an estate planning attorney with Kopenbarger and Kopenbarger. And today we have the pleasure and we have the opportunity to hear from a very, very, very smart and intelligent young man. He is our guest, Zachary Raymond. He is Executive Vice President and a financial advisor for lifestyle investments. And so we are so glad to have Zachary. I'm going to go over the agenda right now, and the presentation is going to be conducted by both myself and with Zachary. And the agenda that we're going to cover today is Zachary is going to cover the Silicon Valley Bank failure and other information that has occurred in the last few weeks. He's going to discuss what's going to be happening and looking forward. He's going to be talking about the SIPC insurance. He's going to be talking about managed accounts, how important they are. And then I will be then talking about FDIC insurance, type of accounts that are covered by FDIC insurance. I will be speaking about trust. And then together, Zachary and I will really talk to you about how we can help you. So I am now going to turn it over, and it's my pleasure to turn it over to Zachary Raymond.
Thank you, Robert. Hello, everyone. My name is Zachary Raymond. I'm Executive Vice President and Financial Advisor at Lifestyle Financial. Our firm has had the pleasure of working with Kopenbarger and Kopenbarger for decades. So it is just a privilege to be here. And Robert, thank you for the kind introduction again. Part of why I'm here is to put in perspective and give a 30,000-foot view without any complicated vocabulary or multi-step processes as to what happened to Silicon Valley Bank and its failure, what is currently happening, and then taking a step out and really explaining all that happened in a healthy framework. And I'll start, before we go to the next slide, I'll start by trying to put this illustration in everyone's minds, where think about what is happening today like a mosaic or a piece of art. If you step too close to the piece of art, you'll see certain lines, if you're an artist, horizontal or verticals, foreground, middle ground, and background. And you need to take a couple steps back to see a whole piece of the art piece, and then take a couple steps further back to see the entire frame or the mosaic. And so that's what I'm going to try to do, because that's the healthiest way to understand all of this and not get too bottled up in one area or another. Everything is important and relevant, but all has to be put in a proper framework. So what happened? Silicon Valley Bank is, as the name entails, located in an area up in Northern California, San Jose, Santa Clara area, just about an hour and a half south of San Francisco, in Silicon Valley, a hub of innovation, technology, companies that become the ones that we use, such as Zoom Video, Google or Alphabet, Tesla, Facebook or Meta. Many companies started here. And Silicon Valley Bank, for decades, and it's been around in many different iterations for over 40 years, was just called the bank. And it uniquely tailored to the funding of these companies before they were big, before they became massively publicly traded companies, before there was any line of credit or any reputation to gather assets or to gather cash to fund their businesses. This was the bank that would really take a leap out, separate from other banking institutions, to get them started and funded. So it dealt with a different clientele. These businesses, the venture capital firms or the deep pockets that would help fund these companies when they were starting, and had unique relationships all along the way. As we have experienced since last year, the Federal Reserve, in order to combat inflation, and again, I'm just trying to give broad strokes here to put it all in perspective, tried to combat inflation by aggressively raising interest rates to make the cost of borrowing money more expensive. What that does, especially at a venue or a location like Silicon Valley Bank that is making loans and extending lines of credit, it makes that business much more expensive. And banks, when they loan out money, once the loan is complete, they're made whole. But from that period of time that they have made the loan, or the duration in which a loan or a line of credit, or if you borrow and give money to a bank and you own a CD, you get interest payments and then you get the entire amount or principal returned to you. During that difference of time, there are losses if the rates change. Silicon Valley Bank uniquely held a very large amount of this on their balance sheet. And with all these rising interest rates over such a short period of time, this distinct event really crippled Silicon Valley Bank structurally, made it uniquely at risk to this interest rate environment. And where do we go from here? Well, shortly after Silicon Valley Bank and all of its losses became public, the FDIC and the local governance within the state of California came in and closed the banks, put it in receivership, and have since begun auctioning off the bank. We currently have a bidder for most of the assets. It's another regional bank called First Citizens Bank out of North Carolina, so that the bank can operate as normal. And we're also going to understand, more importantly, insured and uninsured deposits and how they're made whole looking forward. So let's see where we go from here. Financial stability. We need to put a few things in perspective. There has been a heightened element of uncertainty, and uncertainty is always around us, but given the headline risk and just everything in the background that we've been experiencing for longer than a year, there's been a call into question as to financial stability within the US markets and in the global markets. But there is swift reactions taking place to help shore up this credibility. First of all, it's very important to understand, and we'll talk about this a little bit more, the FDIC has a very large deposit base of over $128 billion. And that is really a backstop that's already funded that they can pull liquidity from at any time. And in large part, what is paying to make sure that deposits, both insured and uninsured, and those words we'll get to later, to make the depositors of banks whole and make them feel at ease when they deposit their cash into a bank account. There's things happening around the world that we have to also be mindful of. Some of you may have heard of a bank in Switzerland, Credit Suisse, that had to close and that has been absorbed by another bank in that country. So this is a global impact. And trying to put that all in perspective is very important and mindful, because these events have happened in similar fashion in the past, and how it comes out on the other side is very important for the future and health of the financial and investment markets. So volatility, it is alive and well. And we're trying to break this up to understand what's tomorrow or next week versus what's farther down in the future. One thing to keep in mind is uncertainty, as I said, always is present, and it's important to put it in perspective. Money has moved a lot right now from smaller banks or regional banks, as they've been called, into larger institutions. That always happens day in and day out, more so now in this heightened arena where people are looking for safety. Big is safe, but we are trying to understand why this institution was singled out. As I said, there were some specific risks that really in the short term are getting unraveled, are going to get repaired. And then as healing takes place in the banking system, especially out here and what the new bank is going to be like, it'll allow people to have a newfound belief and be able to continue business as normal. In the medium term, this is where we start to see some consolidation. We're going to see legislation. We're going to see regulatory fallout. And we're going to see some further revamping of the banking system. That comes after the fact. but it's important to understand that banking as usual is still taking place. We all have automatic payments, or maybe you go down to the bank and get checks for a checkbook. These functions are happening day in and day out, and that reinforces the faith in the banking system. And it's very important to be mindful that this is happening all while the fallout and all of the assets of Silicon Valley Bank and other banks that have closed, there are 3 in the United States that have currently closed, are being worked on. The rest of the system is still more than able to make up for any gaps that we are experiencing. So all the while in the investment landscape, the stock market has been observing and taking action. The stock market does not like to wait and see necessarily what happens. It tries to predict or preempt what happens. That's where you see stark movement and contrasting up and down days in trading, or as you can see by my background, green is good, red is bad, up and down. They are constantly in motion. And in the early innings of what we saw last couple of weeks, there was a lot of noise or volatility. And we need time for the healing to take place. A good reminder is the framework of the great financial crisis that took place between 2007 and 2009. Now, it took a while, but by 2012, the markets had already completely recovered. And then we had the next investment cycle of expansion, where the markets are much higher, companies are much larger than they were at that time. And specifically to the banking sector, there's a whole new element of guardrails, regulatory rules in effect, and different institutions set up to make sure that what happened at that time does not happen again. And we're seeing some of those systems highlighting the holes that maybe were not present for Silicon Valley Bank, but also very importantly, were present so that a Chase Bank, for example, or Bank of America are not going to go through the same things that Silicon Valley Bank went through. So a little bit of vocabulary. The SIPC, which stands for Securities Investor Protection Corporation, is a cousin to the FDIC, but it works on the investment platform. So institutions, some such as LPL Financial, where our firm does business, or Merrill Lynch, which is the investment arm of Bank of America, or JP Morgan, which is the investment arm of Chase Bank, they have SIPC insurance. This allows those institutions, should anything happen to them, to have assets up to a certain price cap, both investable cash or money market funds and securities like stocks and bonds, to have the value be preserved. Why would this be in effect? Well, this would be in effect to offer that same sort of protections should anything happen to those institutions, just like what happened to Silicon Valley Bank. The SIPC has been around since 1970, and it has been used in the past. And all investment companies need to disclose if they're members of the SIPC. They set this up also, and we'll talk about this a little bit later, over different types of accounts, retirement accounts and non-retirement accounts, for example, but we'll get into that in a few slides. So, as I said, the SIPC insurance is designed to cover the investments in investment asset accounts, and this can be broken up to one individual having multiple types of accounts. There are very clear limits. There are also clear rules that will track if there are multiple institutions. So not necessarily if you're at Merrill Lynch, do you get up to that limit, and then you also get protected at JP Morgan. It really breaks it down to follow the individual more so than the individual at an account or at a firm. Accounts. So what we're going to spend the next few minutes on is talking really about the value of managed accounts and how it removes some risk off of the table. Now, a few rules to keep in mind is that when you invest, you are taking money and putting it into an investment, and there is always an element of risk. Part of the job of a financial manager or a financial advisor, or if you're in the investment services, is to take the risk appropriate with your risk budget, which means how much is your appetite given your situation, your unique set of circumstances, going to be appropriate for certain types of investments. We think about how long you're going to be invested, what the goals of the investments are, and what maybe your previous experience has been that have sort of framed how you approach thinking about investments. A couple of investment accounts, as I said earlier, will not be covered by the FDIC. And Robert will go in a little bit later about FDIC insurance. But these are a couple of accounts that, if invested, do fall under SIPC insurance if they're investment accounts. And for example, if you have a bank IRA, there will be another guardrail put in place to protect that up to the insured limit of $250,000. The number is very important because that is a constant number in all of these accounts. So what are some of the advantages of a managed account? Well, there is a very clear advantage that if you have the time and the right sort of recommendation and plan, you can have your cash work for you. You can put in an investment strategy that grows your assets, that can maybe help you to achieve a goal, or set up a wealth to give to the next generation, or for a large purchase such as a house, maybe pay for college. And you don't have to be locked into a CD, limited banking products, or just confined to one institution. There are plenty of other vehicles to consider when you think about investments. It's not just stocks and bonds. You can do insurance products, you can do annuities. The diversification matters. Liquidity, a lot of that depends on what kind of investment you are in. You have instant access to your investment capital in stocks and bonds or in a managed account. Others, you might give up some of this instant access to the value of an account if they're in a product. And so you must have that conversation either with yourself, doing some research, bounce it off the idea of a trusted financial professional. Make sure that you make an informed decision. There's no bell that tells you when you have to invest. There's no clock that says today is the day to start investing or to invest all of your funds. Never feel like it is too late to start or too soon to make a change. You need to balance this with a few frameworks of mind, such as your time that you have. I always tell clients that you get rewarded for time in the market, not timing the market. You also want to bear in mind that there is no such thing as the right or the direct wrong time. Markets do not historically ring a bell at the bottom. They also don't ring a bell at the top. So part of the process that you must go through, and a managed account really guides this, is you set rules in place that your trusted financial professional educates you on and revisits with you to make sure that the investment strategy is holding true. We experienced this a lot last year because we had record high inflation not seen in over 4 decades. So if the strategy was appropriate, it handled this inflation. It handled the massive change or the rise in interest rates, not only in the US, but around the world. Few things that are also going around all the time that allows you flexibility in a managed account would be to deal with geopolitical risk, the Ukrainian-Russian conflict, the trade war, and the scramble for technological dominance between the US and China. Political risk, both in the United States and abroad. All of these factors are going on 24/7. So your investment profile, your investment risk, that custom approach is what is really important to help you not be your own worst enemy. It is much easier to make a quick decision than to have this discipline of a plan and stay with it for longevity. Managed account process does that. And then as a line of added defense for the long term, working with a trusted professional, having a disciplined set of skills is what best ensures you to achieve the goals you have in financial planning or just getting started, trying to achieve a goal. As I had mentioned, there are many different venues for managed accounts and investment considerations. So part of what we look at is if you are a business owner and you need to protect cash flow, that's part of the financial plan. If you have alternative investments, such as real estate or private equity, that also becomes part of your financial picture. It all has a role to play, and it's all supposed to be balanced together, not just stocks and bonds, money in a bank account, all of it. Structured notes or advanced products, our firm and other firms are licensed to deal with these specifically and talk about them. You need to understand what's under the hood, I like to tell people. You just have a very nice car in the parking lot, or if you go to the dealership, you want to see how it works. So it's important to be mindful of this. And these investments are constantly changing. They don't just sit in a place and never move. They're constantly being innovated, or there's changes in the investment conditions or environment that will impact these investments in the short term and then have longer term implications. And I think I'm going to hand it off to you now.
Zachary, I appreciate the in-depth discussion that you have provided to us. I have learned just listening to you. My role now is to cover the other type of insurance, FDIC insurance, which has also been around for a very, very long time. And it has really the opportunity to make investors feel more comfortable and more secure when they put money into banks, because as we already know, banks fail. But when a bank that is what I call an FDIC insured bank, now be aware that not all banks are FDIC insured. You have to be careful to have a bank that is FDIC insured, that when these banks fail, as we just saw the bank in Silicon Valley fail, the purpose of FDIC insurance is basically to protect the bank depositors from the loss of their insured deposits. And the term that is used is that is backed by the full faith and credit of the US government. So the FDIC insurance is put in place to give all of us who invest or put money in a bank the security that we feel that if the bank fails, that we will get our money back. Now, the interesting thing when I started to look at the FDIC insurance coverage, when I started to look at the various types of accounts that FDIC insurance covers, I really learned a lot in the sense that we normally listen or we are aware that, oh, FDIC insurance, for example, covers at least $250,000 of the deposits that are insured. And that's per depositor, per insured bank, per account ownership. So when you read these, I'll call it titles, you start to wonder, what in the heck do they mean? Well, we all know that if we open a bank account in a bank, FDIC insured bank, right, that account is in your name. It will be insured up to at least $250,000. And again, it is per depositor, meaning who is the person who's making the deposit. And also you have to, again, be aware that it has to be a FDIC insured bank. And then the interesting thing is that the FDIC coverage depends on the type of account ownerships that exist. So what I'm going to do is I'm going to explore, number one, a couple of, I'll call it acronyms or statements that are made. Whenever you get into any type of new area, whether it be law or investments or even space products, for example, there's a whole list of new acronyms and definitions and so forth. So I found it very interesting that there were two main, I'll call it names or titles that needed clarification. Number one is a depositor product. You'll see, if you start to read about FDIC insurance, you will read and you will find the term depositor product. Now, what does depositor product mean? And that title, what it means, that description, is that that is an account that is FDIC insured. For example, a plain bank account. And so depositor product identifies the accounts that are FDIC insured, because as Zachary explained, not all deposits are FDIC insured. Some of them are insured because they're classified in investments by the SIPC insurance that he talked about. Now, the other, I'll call it title of a category, is called ownership category. And so what that meant was, how are you holding the account? Are you holding it as a sole proprietor? Are you holding it jointly? Or you hold it with your husband, with your spouse, or you hold it how are you holding the account? So it's important to differentiate them between depositor product, the account that's FDIC insured that you're going to open, a straight bank account, for example, or a CD, and ownership category. How are the accounts then going to be held? Because these two definitions are really the key to understanding how the FDIC insurance works. So, question that's always asked. I've been asked this question so many times that the first thing I want to do is I want to identify what that question is. And one of the questions is always, hey, Robert, I hear that my account can be insured up to $250,000 by the FDIC insurance. Of course, that's true. But hey, I've also heard that you can have more than $250,000 of deposit insurance by the FDIC. And the answer to that is yes, of course. But remember, the deposit that is insured depends on the type of account that you have. Again, is it a straight bank account? Is it a joint account? Is it a CD, for example? And again, is that particular type of account FDIC insured? And again, we're falling back now to the previous definition, is type of ownership. That's critical. The 2 points again. How do you identify how much and how the account is FDIC insured? Depends on the type of account and the type of ownership. And the type of ownerships can be single, joint, in a trust, revocable, or irrevocable. And I will then cover the type of accounts that we're talking about. So just to recap as to where we are right now. A, you have to make sure that your accounts are in an FDIC insured bank, a bank that has FDIC insurance. Number two, you have to make sure that you understand that the type of account that you're opening at the bank is a deposit that is FDIC insured. And three, you have to understand that the way you hold title will also affect the amount of insurance that that account will have. So that's where we are up to now. So what type of accounts are FDIC insured? Now, Zachary identified accounts that are not FDIC insured because they're insured by a different kind of insurance. He covered that very thoroughly. So what type of accounts are FDIC insured? Well, we all have checking accounts. We all have saving accounts. We all have money market accounts. We all have certificates of deposits. Now, because of the time is limited during this webinar, I am not going to cover all the other type of accounts that are insured, FDIC insured, because there are business accounts. There are other kinds of deposits that are held. And so I'm limiting the discussion right now to the most common type of accounts that we all have. Again, your normal checking, your normal savings, your money market accounts, and your CDs. Those are basically the most common type of accounts that we all have. And the discussion is basically to cover that. Now, as Zachary eloquently explained, and I'll have him come back in and cover one more time, what type of accounts are not FDIC insured? And Zach, I welcome you.
Yeah, thank you, Robert. So as Robert was saying, various bank accounts or certificates of deposit, money market funds. There will be some FDIC insurance, but stock investment accounts, bond investment accounts, and bond investment accounts can be investment accounts that are in multiple different CDs. So that would be a separate discussion. I'm more than happy if people have questions about that to dive into. But it's very important to understand bonds and CDs or certificates of deposit. That's all in the bond family. Mutual funds held by a mutual fund company, provided that they are under the SIPC. Crypto assets, to be very honest, are still a growing space. And there is yet to be full insurability on crypto assets. Our firm does extensive research on this because it is an asset that is here to stay, but it is still in its early innings, we like to say. Annuities, there's investments within the annuities and there are guarantees built in those products. Safe deposit boxes and those contents. You usually want to insure precious metals, for example. So you would insure what is in the safe deposit box. Robert, I'll turn it back to you if I missed out on anything here.
Thank you, Zachary. By now, I think just listening to the short discussions that we've had with you, it is not as simple as you may think, or at least how I thought, that we simply put money in the bank and it's insured. We have to be smart. We have to understand what categories we're talking about, because we have to make sure that the money that you work so hard to accumulate and to have and to protect is properly insured. And for that, we have to understand the type of insurance and the type of account, et cetera, that is going to be covered by these type of insurances. Now, the ownership categories, remember we talked about, well, there were two main categories that we talked about. One was product category. I'll repeat it again. Product category is identifying the type of account that is going to be FDIC protected in an FDIC insured bank. So the way you hold your account, the way you title the account, that is key as to how much FDIC insurance the account may have. The amount of FDIC insurance coverage then, again, depends on ownership category. So I am beating a horse to death. Two items: product identification, ownership category. Those are the things that we have to focus on. So let's cover the most common type of owner categories that we all have. We all have single accounts. We all have joint accounts. And in the world of estate planning and the world that we work in every day, we always have trust accounts. And I will cover trust accounts in a little bit more detail. But these are the most common type of accounts that we see. So I want to make sure that we explain to you how these accounts are insured. So, ownership. What are the coverage limits? I have a savings account. The account that I have is, I'm making the number up, okay. The savings account that I have is $50,000. So how much is that account insured for? The account is in my name, single individual. I have $50,000. Well, it's only going to insure the amount of money that I have, but the coverage would be up to $250,000. Just because I have $50,000 in the savings account and there's $250,000 of FDIC insurance does not mean that the remaining $200,000 is going to be paid back to me. Okay. I have a checking account in my name. I have a money market account in my name. So this is a simple explanation that all single accounts owned by the same person at the same bank are added together and insured up to $250,000. Again, this is an example, I have a $50,000 savings account. I have a $50,000 money market account. I have a 150,000 checking account at the same bank in my name alone. So they add up the accounts, they add up to 250,000. So my money is fully insured up to the $250,000 limit. Does that make sense? Again, product category is important. Joint ownership. A lot of us, or a lot of you, may have accounts in joint ownership. Before I go into the explanation of this, I would like all of you to look at the picture of that young man and young lady. Take a good look. You recognize who they are? Kathleen Turner, Michael Douglas. Remember Romancing the Stone, War of the Roses. These are pictures that they appeared in, and we thought it would be nice just to have them and for us to remember how they looked at in their youth. So, getting back to joint owners. There are a couple of requirements for joint ownership accounts. Okay, number one is, some of these are kind of obvious statements, but believe it or not, it has to be in law, basically that, hey, if you're a joint owner, you have to be alive. You have to be a living person. Number two, in a joint account, you both have equal rights to withdraw the money. And another interesting factor is that you both have to sign the signature card at the bank. I thought that was a very interesting little caveat, which I discovered, and that is you go to the bank and the operations officer is going to look at you and he's going to say, hey, you guys look like you're alive. I'm going to open up a joint account. Both of you have to sign the signature card and you both have equal rights to the account. So how is a joint account insured? Each co-owner is insured up to $250,000 of the interest in all joint accounts at the same bank. Again, remember, product identification, ownership category. So if I am a joint account holder with myself and my wife, and I have $100,000 in that account, we both have $100,000 in that account, that's $100,000 of FDIC insurance of that account, right? But then if I have another $150,000 in another joint account with, let's say, my son, bad idea, by the way, then they're going to add up all of the joint ownership in the accounts that I have. They're going to add them up. And if it's under the $250,000, then it's going to be insured up to $250,000 of my interest in all the accounts. So again, it's important to understand how these accounts are categorized. Let's talk about trust for a minute. All of you are aware as to what a trust is. It is a legal document that is created. That can be created by a single individual. It can be created by a husband and wife. And basically, it's a legal document that is in place to generally protect you while you're alive from incapacity issues, and also upon death allows you to distribute then the property in the way that you want to distribute the property to whomever you want and so forth. It's an absolutely wonderful, wonderful document to have. We have many, many webinars on how a trust works, what the pros and cons of a trust are. And I encourage all of you to go to our website at copenbarger.com, and you can all listen to these webinars on all these different types of trusts that we create at our office, and they're all free for you to access. So we welcome you to go to our website to listen on discussions about trust. But today, I am not going to be talking about how a trust works and so forth. What I want to talk about is the FDIC treatment of trusts. Now, the banking system talks about trust in two different ways. We, as a law firm, talk about trusts generally We talk about them in the family of revocable. We talk to them about the family of being irrevocable and so forth. But we never really identified, we don't have the distinction of calling them informal trust accounts or formal trust accounts. And the informal trust accounts, that basically is kind of like a banking segregation of trust. And those type of accounts that fall under the category of trust accounts in the bank are pay on death accounts. What is the pay on death account? I, Robert, open up a savings account and I say, upon my death, I want it paid to my daughter, Andrea. That's a pay on death account. What is an ITF account? That one is an in trust for account. I open an account in trust for Andrea. The term Taunton account is pretty much almost like a summary of what a pay on death and a in trust for type of accounts is. It's a very general term that is used, not often encountered, that the banking system that differentiates from what they call formal trust accounts to informal trust accounts. But the informal trust accounts, like I identify what they are different than the formal trust accounts. The formal trust accounts are the type of accounts that, or the type of trust that you have with us, or that we have prepared for you, or maybe you have gone to another law firm to have them prepared. And those are generally the revocable trust accounts, the formal trust accounts that are created either by you or someone else. It can be also revocable trust. These are formal trust accounts. So the banking system then, again, differentiates between informal trust accounts and formal trust accounts, but they're all are trust accounts, and they're covered in the same manner as far as the FDIC insurance is concerned. So let's talk about the most popular form of trust that you probably have, and that is the revocable trust. It goes by the name of revocable living trust. These are the type of documents that you have created, either, again, by yourself or with a spouse. And these are revocable, meaning that these trust accounts can be revoked. They can be amended during your lifetime. Those is generally the type of account, trust account, that you have. The majority of you have this type of account. So let's find out, if you have this type of account, how are they FDIC insured? All right. Number one, like I mentioned earlier, the banking system applies the same rules for formal and informal. Okay. Second, the account that's open can be owned by one or more individuals with identifiable beneficiaries. What does identifiable beneficiaries mean? It simply means that the particular trust that's created clearly identifies who would be receiving the funds upon the death of the owner. So it has to be a deposit account owned by one or two more people, with who are going to be the beneficiaries who will receive the deposits upon the death of the owner. Next, all revocable trust accounts owned by the same person at the same bank or added together, and the owner is insured up to $250,000 per beneficiary. I will repeat it. You have a trust with us. We have always encouraged for you to have your bank accounts owned by your trust. If your revocable trust clearly identifies the beneficiaries. And in this example, I'll say that the trust was created by husband and wife, and they had 2 children, Jack and Jill, as beneficiaries, clearly identified in the trust document. So therefore, how much is this trust account insured for? It is insured up to $250,000 per settlor, creator of the trust, and the 2 identifiable beneficiaries. So here's an example that your trust account opened by the husband and wife with 2 identifiable beneficiaries can be FDIC insured up to a maximum of $1 million. That's how you can get more coverage than the straightforward $250,000. Fantastic. All right. Now let's talk about irrevocable trust. This is a little bit more complicated. And when I started to review the rules for this portion of the presentation, I was really surprised by a couple of things. Number one is the banking world looks at the irrevocable trust. Well, first of all, let me tell you, what is an irrevocable trust? Well, remember the revocable trust, you could update it, amend it, revoke it any time during your lifetime. An irrevocable trust is the type of trust that you create irrevocable. You cannot change it, you cannot amend it. And yes, there are laws in California that would allow you, under certain circumstances, to work with the irrevocable trust, but that generally winds up being a court hearing in front of a judge. But so irrevocable trust, I want you to understand, is the type of trust that cannot be changed. So why is the bank making such a big distinction between the revocable and the irrevocable trust? They start to talk about 2 terms called contingent and non-contingent. So what are these terms? Well, a beneficiary can be non-contingent. What does that mean? I leave everything to my daughter, Andrea, period. There are no conditions that have to be satisfied before she gets the money. There are no contingencies. There are no requirements aside from my death for the money to go to Andrea. What if Andrea was a contingent beneficiary? That would mean that I will leave the money to Andrea only if she marries a rich person. That's not a good idea because that's against public policy, but the idea is that contingent means a beneficiary that is only going to get the money based on something occurring, on a contingency occurring for them to get the money. That's what the bank looks at, because they want to make sure that the beneficiaries are non-contingent, because funds representing contingent interest are only insured up to $250,000 in the aggregate. Irregardless of the number of beneficiaries that you have identified, because they're contingent, they may never get the money, so therefore there's only one $250,000 in the aggregate for all the contingent beneficiaries. The non-contingent, in this example that I gave you, that upon my death, the irrevocable trust would pay to Andrea, my daughter, to Michael, my son, with no contingency whatsoever. Therefore, they're non-contingent beneficiaries, and therefore each beneficiary that I've identified is insured up to $250,000 for each beneficiary. It's critical then to understand how the bank looks at the beneficiaries that are identified in a trust. Then there's one more wrinkle. And I'm not going to go into the detail of explaining this one because this is a complicated concept, but if the creator of the trust retains some sort of interest in the irrevocable trust, there are some types of trusts that are created where the settlor does retain a certain interest for income, for example, and then they look at the settlor and they aggregate his accounts with other accounts at the bank for another $250,000. So what is my advice for irrevocable trust? Look, this is really, to simplify all of this, is if you have funds that are held in an irrevocable trust, my suggestion is keep the funds in separate FDIC banks and don't put more than $250,000 in each bank, because this is too complicated. And here's what happens. When you submit an irrevocable trust to be reviewed by the legal department with the various banks, they will come back with their own interpretation, and their interpretation may not be what we think it is or what it should be. So therefore, my simple advice is irrevocable trust, keep the accounts in separate FDIC insured banks, and keep the money under the $250,000. Well, another example. When you have a revocable trust, I'm going to use a simple husband and wife created at a revocable trust. At the death of the second spouse, then the trust becomes irrevocable. And let's assume that Jack died. Jack is the husband, Jill is the spouse. And when the trust became irrevocable, Jill became the sole trustee. And the beneficiaries were Jill and her kids, Bob and Sue. But the terms of the trust identified that the trustee had discretion to allocate the money, which meant that there were contingencies, and therefore these beneficiaries were non-contingents, and therefore the account in this example had $750,000. 500,000 of it was not covered because the total deposit on that particular trust, remember, if the trust becomes irrevocable, when they cannot figure out if they're all non-contingent beneficiaries, the maximum insured deposit is $250,000. Again, my recommendation, keep the amounts of an irrevocable trust in separate banks with the amounts under the $250,000 so you're covered. Well, Zachary, it is time for both of us to come in and jump in, and we can identify then how can we help everybody that's been on this call.
Well, Robert, as informative as always, I think one of the biggest takeaways that can't be said enough of how estate planning and financial planning go hand in hand. I cannot tell you how often enough when you go through all the work to make a trust, sometimes, and it's human error, it happens all the time, but investment accounts need to be put in the trust. Just as Robert said, you have to have the bank account in the trust in order for the trust to protect you. The same rule applies on an investment account. Even if the nickname might be Mr. and Mrs. Jones Revocable Living Trust, it must be a trust account in order for the assets to be in the trust. And due to how complex investment and banking regulatory rules are, if those assets are not in the trust, there will be times when you might not be able to have those assets go as intended by the trust. And Robert, I know we had talked about this. It's not an uncommon thing for assets to sometimes be out. And one of the greatest asks that I always tell people is let us know. We will take a look just to make sure that everything is exactly where it's supposed to be. That is the biggest recommendation I can give to people right now.
Zachary, I think that is an absolute wonderful recommendation, and I want to bring to everybody's attention as who Copeland Barger Law Firm is. We've been around since 1979. The majority of you on the call are clients. There's 8 full attorneys, and what I'll always like to tell people is you hire one of us, you hire all of us. And the combined experience is over 350 years of combined experience. And we have certified specialists in probate, estate planning, and trust law. There's some of us that have advanced tax degrees. We have an unbelievable support staff, qualified support staff, paralegals. There's a CPA on staff. It is a mega firm, and we only do one thing, and that one thing is estate planning. We do not do bankruptcy. We do not do divorce. We do not do criminal law. I like to tell our clients that we only work on Ford trucks. We're all interchangeable. We specialize, and therefore we know what we're doing. Our recommendation is to come in and see us. Zach, explain to us who is Lifestyle Financial.
Thank you, Robert. Yeah, Lifestyle Financial is practically as old, if not slightly older than I am. We like to call ourselves a family helping families, as there's multiple generation of advisors. We do have everything in-house, backed by the institution LPL Financial, which is one of the larger investment brokers out there at over $1 trillion of assets from financial firms such as by myself and my partner, Charles Sosa. Some of you may know and or have met one or both of us. We do offer comprehensive wealth management and financial planning. This is where we take what is called the holistic financial view, where we customize the entire library of knowledge that we have, how it fits your specific situation for yourself, maybe you and your business, you and your family, you and your plans. We offer an extensive network. We do, for everyone who is an attendee of the webinars or any Copen Barger referral, is a free financial review. Yes, that is free. You can quote me on that. That's the only guarantee in financial planning I am legally allowed to offer, a free financial review. We have multiple office locations in Northern and Southern California and Zoom, and we do try our best to customize the approach. It is not one size fits all for investments. It should be the size that is appropriate. We don't always tell you what you may want to hear, because we have to tell you the truth, and that's what you will get from every advisor at Lifestyle Financial.
Zachary, that is fantastic. Again, for all of you, we're here to help. We would love to hear from you. On the screen, you see our telephone number. You see our website. There's our email information. And at this point, what I want to do is I want to thank all of you. I want to remind you that when you come into the consultation with us, we always, particularly on the estate planning side, we want to see your current existing planning documents. And if you're going to make an appointment, we're going to send you a confidential data questionnaire that we would like for you to also to complete, and also gives you the opportunity to list questions for us, and also be thinking about the other questions that you might be wanting to ask Zachary or myself. And again, we appreciate that you spent the time with us, and we want to thank you very much, and we bid you a wonderful day. Thank you very much again, and goodbye.